Most investors think they're early to AI. They're not. They're just late to the right part of it. Everyone keeps chasing the software names, the chatbots, the chips, the headlines, but the real money in every gold rush isn't in the gold. It's in the people selling the shovels. Applied Digital is one of those shovel sellers. Most of Wall Street hasn't figured that out yet. This company just locked in over $11 billion in long-term contracts with CoreWeave. Its stock is up more than 330% this year, and yet it's still losing money every quarter. So here's the question of the day. Is this the next AI infrastructure giant in the making, or just another over-leveraged dream burning through cash before the real players show up? Because if you understand what's happening underneath the hype, the data centers, the financing, the math, you'll see the part of AI nobody's talking about, the part that could either mint millionaires or wipe them out. Let's separate the story from the scoreboard. Every growth story starts with one deal that changes everything. For Applied Digital, that deal was CoreWeave. CoreWeave isn't some small AI startup. It's one of the fastest growing hyperscale compute providers on the planet, backed by Nvidia and Magnetar. And they just committed to lease 400 megawatts of power from Applied Digital's data center campus in North Dakota. That's not hype. That's a 15-year contract worth roughly $11 billion in future revenue. Here's why that matters. In the world of infrastructure, long-term leases are everything. They turn a speculative builder into a cash flow machine, at least on paper. For Applied Digital, it means predictable multi-year revenue and the credibility to raise billions more in financing. But there's a catch. Those contracts are locked in before most of the buildings even exist. They're betting billions on construction timelines, power delivery, and cooling technology that still needs to be proven at scale. So yes, the CoreWeave deal is massive. It gives Applied Digital legitimacy overnight, but it also pins the company's entire future to a single partner. If anything slips, the whole thesis cracks. The takeaway: this isn't diversification, it's concentration. One bet, one partner, one shot at becoming the backbone of AI infrastructure, or collapsing under the weight of it. On paper, the last quarter looked incredible. Revenue jumped 84% year over year to $64.2 million. That kind of growth makes headlines, but the story behind it, not so pretty. Adjusted EBITDA dropped from $6.3 million last year to just $0.5 million this quarter. Net income flipped from $15.9 million in profit to a $27.8 million loss. And operating expenses, they exploded. SG&A rose 165% from $11 million to $29 million. Over $16.6 million of that came from stock-based compensation, more than 1/4 of the total revenue. That's not growth efficiency, that's expansion on credit. Every dollar they make is being recycled into construction, payroll, and power infrastructure. They're building for a future that hasn't arrived yet, betting that demand from AI hyperscalers keeps growing fast enough to cover the burn. Here's the brutal truth. Growth without profitability is a liability. Revenue proves interest, profits prove execution, and right now Applied Digital is showing one without the other. The takeaway: the scoreboard says record growth, but the income statement says red ink. This is not operational strength. It's a print on borrowed cash, hoping scale will eventually save the story. When a company burns cash faster than it earns it, survival depends on who's willing to fund the dream. For Applied Digital, that lifeline came from Macquarie Asset Management, one of the largest infrastructure financiers in the world. Macquarie gave Applied Digital access to a $5 billion preferred equity facility, and the company has already drawn $112.5 million to finish its first mega campus, Polaris Forge 1. They also added $50 million in equipment funding and another $200 million from preferred stock offerings. On paper, this looks like the perfect partnership. Stable capital to build billion-dollar data centers. But here's the part most investors are missing. Big money doesn't come without strings. Preferred equity isn't free. It often means priority claims on cash flow, limited flexibility, and pressure to perform. When one partner controls most of your funding, they don't just finance your vision, they own your runway. Applied Digital's entire future expansion, from North Dakota to future campuses, now depends on Macquarie's continued confidence. If that confidence fades, the momentum stops instantly. The takeaway: this isn't just financing, it's dependence. Macquarie may be the reason Applied Digital can scale, but it's also the reason the company no longer controls its own pace. In business, advantage comes down to doing what others can't. faster, cheaper, and more efficiently. Applied Digital's entire moat depends on those three words. First, speed. Traditional data centers can take 24 months or more to build. Applied Digital cut that in half, down to roughly 12 months from concept to delivery. That speed is everything when hyperscalers are desperate for compute capacity and GPU-ready power. Whoever delivers first wins the contract. Second, scale. The company's Polaris Forge 1 and Polaris Forge 2 campuses together are designed to exceed 1 gigawatt of total capacity. That's industrial strength. If both sites reach full lease-up, Applied Digital will become one of the largest AI infrastructure providers in North America. And third is location. North Dakota gives them a major cost edge, low-cost energy, abundant land, and over 200 days of free natural cooling every year. Their proprietary closed-loop, direct-to-chip liquid cooling system lowers water use to near zero, which matters when ESG pressures are rising and energy demand is exploding. But let's be clear, this moat is operational, not technological. There's no patent protecting fast construction or cold weather. The advantage lives in execution, not IP. The takeaway, Applied Digital's edge isn't magic, it's muscle. They build faster and cheaper than most, but if they ever slow down or someone bigger builds faster, that moat disappears overnight. Now let's talk about the ugly truth about cash flow. Every company loves talking about revenue. Nobody wants to talk about cash, and Applied Digital's cash story is brutal. In the last fiscal year, operating cash flow fell to negative $115 million. Capital expenditures exploded to $682 million. Debt ballooned from $136 million to $687 million, and that was before the company pulled another $362 million in financing after the quarter ended. When you see numbers like that, you're not looking at a cash flow statement. You're looking at a construction burn chart. They're spending like a real estate developer in a boom cycle, except their buyers haven't even moved in yet. Here's what that means in plain English. Every dollar Applied Digital brings in gets recycled straight into new campuses, new cooling systems, and new power buildouts. The company is scaling for AI demand that may or may not fully materialize. They're betting tomorrow's revenue will justify today's debt. That's not investing. That's leverage disguised as growth. The company wants to hit a $1 billion NOI run rate within 5 years, but it's doing it with negative free cash flow margins north of negative 500%. That's an Amazon-style risk profile without Amazon's cash engine to back it up. The takeaway, Applied Digital is building the infrastructure for the AI future, but right now it's bleeding to get there. The dream is big, the burn is bigger. So is Applied Digital a good long-term investment? Every investor wants the next Nvidia. The problem is most chase stories that sound like Nvidia but bleed like startups. Applied Digital is one of those stories. Let's start with the facts. The company has $11 billion in contracted revenue with CoreWeave. It's backed by $5 billion in financing from Macquarie. It's scaling faster than almost anyone in the AI infrastructure space. Those are real wins. But then look at the scoreboard. Net margins are negative 141%. The free cash flow margin is negative 574%. Debt is up 400% year over year. The company loses money on every contract it signs today, hoping future scale flips the math. Profitability isn't expected until 2028 or later, and that's if everything goes right. Now let's talk about moats. Applied Digital doesn't have one. It has execution speed and location advantages, both temporary. If a better capitalized competitor moves faster or offers cheaper power, those edges disappear. There's no proprietary tech, no switching cost, no long-term lock-in beyond leases. So, is it a good long-term investment? No. It's a speculative infrastructure play with enormous potential, but even greater financial fragility. You don't buy this for stability. You buy it because you're betting on a small company surviving long enough to become a giant. The takeaway, Applied Digital isn't a long-term compounder. It's a high-risk long shot. It could 5x or it could collapse. The difference isn't luck. It's execution. Applied Digital is getting stronger operationally every quarter, but financially, it's getting riskier. Revenue is up, contracts are up, capacity is expanding, but so are the losses, the debt and the dependency on a single customer. That's not stability, that's leverage dressed up as growth. This latest earnings report doesn't reduce the risk of owning Applied Digital, it increases it. The company is scaling into a massive opportunity with borrowed money, thin margins, and no real moat. It's the definition of high risk, high reward. If everything goes right, new campuses built on time, hyperscalers locked in, power secured, the upside could be huge. But if financing dries up, if CoreWeave pulls back, or if AI demand slows, this stock could collapse overnight. My thesis? I'm bullish on the vision, bearish on the timeline. This is not a long-term core holding. It's a speculative bet that belongs in the money you can afford to lose bucket. I covered Applied Digital today because a lot of people have asked. It's a high-growth, high-risk stock that's still unprofitable and likely will be until 2028 or later. I'm a long-term investor who prefers companies that already make money. That means Applied Digital doesn't fit my strategy. But if I see a setup I like, I might take a small position, knowing full well it could either double or disappear. That's the real risk-reward profile here. So here's the takeaway. Great story, massive upside, but for now, it's a pass for me. You do you, boo. Now let me ask you something. Who else is breaking down real earnings data, cutting through the hype, and showing you the truth about what's actually driving these stocks, while also teaching you how to trade them with precision? Nobody. That's why I built my Patreon, because talk is cheap, execution pays. Look at Krista, 6 months in, up 12.5% in one day and sitting on a 57.57% return year to date. That's not luck, that's process. And Jungle pulled in $1,500 trading the downside, selling covered calls to hedge during volatility. That's strategy, not guessing. And for full transparency, my accounts are up $2.35 million this year, which is 67% year to date. That's not a theory, that's also execution. Inside my Patreon, you get real-time trade alerts with entries, exits, and the reasoning behind each move. Daily market breakdowns that cut through the noise and focus on results. And the exact momentum system I use to scale seven-figure positions with control. And a community that executes, not one that argues about headlines. It's only $30 a month. People waste that on coffee runs. This could actually pay you back. If it doesn't sharpen your discipline, grow your account, and make you a better investor, cancel anytime. No pitch, no pressure. But if you've been watching these videos, nodding along, telling yourself you'll join next week, stop waiting. You can scroll or you can scale, but either way, don't say you weren't told.